Hello and welcome to Econoday Unplugged on Tuesday, the 16th of March 2020. Mark Pender is on the US East Coast and I'm Jeremy Hawkins here in London. Well, where to start? Last Wednesday, the World Health Organization declared the coronavirus a pandemic, and as more and more national barriers go up, and equity prices extend their hugely volatile move down, the crisis continues to wreak havoc on the global economy and financial markets. Travel, hotel, pubs and restaurants are all getting hammered. And as the lockdowns become more widespread, so businesses start to slide into what amounts to a government-induced coma, the situation can only get worse. Last Friday, President Trump declared a national emergency in the US, which joins a growing list of countries in the same boat, including the likes of Italy, Spain, Switzerland, South Africa, Slovakia and the Czech Republic. According to the VIX index, which closed at a record high on Monday, uncertainty levels are through the roof. And monetary and fiscal policymakers must be increasingly concerned that, at least so far, their actions have done nothing to halt the carnage. Even a 100 basis point Sunday rate cut and new quantitative easing from the Fed failed to provide investors with any real confidence. As we record this podcast, some 35 central banks have now cut interest rates in the last couple of weeks, some, including the Fed, more than once, and all have provided a significant boost to liquidity. However, markets did respond well to last Friday's US state of emergency announcement. That freed up about, $50 billion worth or so of federal funds for injection into the economy. So it does seem that investors are looking more for fiscal rather than monetary action to prevent what is a rapidly rising risk of global recession. So, Mark, I see there's just a few moments ago talk about an $850 billion package from the White House. Do you think that will get through? And for that matter, do you think it's enough?
Well, I don't know. We don't know if it's going to be enough. It's going to be something. Certainly, and I've been them out of Europe. A German, was it 550 billion euros? Macron, I think, was talking about a 300 billion for France. So these are all, and those are euros, and these are all, when Jerome Powell was talking on Sunday after the emergency rate announcement, 100 basis point move, at Sunday, late Sunday Eastern time for early Asia markets on Monday. And he was very clear that, this has to be followed by fiscal policy. So it's like you said, central banks are doing all they can, whether they really can't pull out any more stops. It wouldn't seem. There was just one that came out here for supporting the commercial paper market. So they're going to try to keep everyone solvent and try to limit the risk of cascading defaults. And we haven't seen that yet, knock on wood. And but I guess that would be the next shoe to fall, corporate debt collapses and those things, and that would be another blow to the market already. But they were doing all they can, and hopefully the fiscal stimulus will kick in, and hopefully this virus its impact will be limited. I'm looking here for what the latest in Italy is. And do you have any news?
Well, Italy at the moment, essentially, indeed, with a whole range of countries now across Europe, and within that you include pretty well France, Austria, Spain. They're all, to all intents and purposes, in lockdown now. So it really is kind of draconian measures to try and sort the virus problem out and contain it on borders. And it's the border side which actually is starting to get quite interesting. As of yesterday, we saw the EU Commission effectively coming out and suggesting that they want to put up barriers to non-EU travel. Now, this is done with a view to trying to prevent, carriers of the virus coming into the EU, or indeed, for that matter, residents within the EU who have the virus actually effectively exporting it overseas. Now, the problem with this is that although the European Union announced that they want to do this, so non-all essential travel into the bloc, and that's supposedly going to last for at least 30 days, a number of members are already erecting their own national barriers, say France, Germany, Italy and Spain. So the big four Eurozone countries are already in the midst of putting their own barriers up to start with. Now, of course, this flies completely in the face of the idea of a single free market, a single free market across the European Union. So we're starting to see some real political strains taking place across the Eurozone now. And depending upon, of course, on how this pans out, it could really have some quite significant future implications for the future political situation across the Eurozone as a whole.
Which makes me think of the euro, and they do have a unified currency. And part of what's going on right now is everyone is joining in rate cutting, and everyone is doing fiscal stimulus, but not everyone can lower their currency. So someone somewhere is going to have to be willing to accept a higher currency. And right now, the euro has been one of the stronger currencies by far. And will that continue, or will there be political move there above the table or below the table to weaken the euro?
I don't think they'd do that. In fact, I mean, as we speak, we have seen we've seen, it's interesting looking at dollar euro because we've seen a fair amount of volatility in that currency pair really since coronavirus began. And we had a period when initially we had the coronavirus announcement and you get this uncertainty and rush to safety. And we duly saw the dollar appreciate quite significantly against the euro. Then we had this period when the Fed started to respond and a good deal more aggressively than the likes of the ECB through its interest rate cuts. So we saw interest rate differentials, although they were still in favor of the dollar, narrowing quite significantly, and we saw investors then moving out of the dollar and into alternative currencies such as the euro. But now it seems as if we've had this escalation of the virus, that the dollar's actually starting to look one of the safe haven currencies again, and we're back in that kind of environment. So I think we've seen having seen the Fed cut interest rates on Sunday, it hasn't really done that much to the dollar at all, whereas if we went back to the first round of Fed cuts, we saw the dollar being hit quite significantly. So I think at this stage, to be honest, I don't think too many policymakers are too worried about what's going on in the currency markets because they've got too much on their own plate at home to try and sort out.
Let's take two places that are concerned, Japan and Switzerland. Those are two banks that are two places where the currencies has been rising and two places where interest rates are already below zero. So let's now tell us about the Swiss National Bank coming up.
Good point. It's a good example, I think, with the Swiss National Bank. So they're holding their meeting on Thursday. In contrast to a lot of the other sort of, the big central banks, the SNB, Swiss National Bank, hasn't actually really done a great deal in terms of adjusting its own monetary policy to take account of what's going on with the virus. So they did participate in Sunday's coordinated move amongst, 5 or 6 central banks to boost global US dollar liquidity. But in terms of interest rates, they haven't done anything, a bit like the ECB last week. And really, as you mentioned, that comes down to the fact that when you look at, the whole Swiss yield curve, it's well below zero now. Their deposit rate, their main policy benchmark rate, is minus 0.75% and has been for a number of years. And there's this ongoing stream of complaints coming out of industry and particularly the banking sector to the effect that they're being crucified by the fact that interest rates are so negative in the first place and their profitability is being completely undermined. So I think although you can't say it's impossible that we'll see the SNB coming out and doing something on interest rates on Thursday, it seems unlikely. But it does mean that they're having to wear it on the chin in terms of the currency. And as we speak, Euro Swiss, so this is Swiss francs per euro, is trading a little bit above the 105 mark. If people remember when the Swiss National Bank, I should say, had a target floor for that exchange rate, it was all the way up at 1.2, so 120. So effectively, the Swiss franc's already appreciated the best part of 15% or so, compared to the level which just a few years ago the Swiss National Bank thought was fair value. Now, what they have been doing behind the scenes, because they don't normally make much noise about this, is that they've been intervening quite aggressively. And certainly over the course of the last few weeks, as we've seen all this volatility in the markets, really instilling an extra appetite for safe haven vehicles, the Swiss National Bank has been very busy. currency. So it's been selling Swiss francs and buying euros, trying to put some kind of floor underneath euro Swiss. Now, it's got to be said, it hasn't really been that successful. It appears to be trying to put a floor about 105 mark at the moment. But to be honest, if we continue to see the virus and all the volatility continuing, there's every chance that we'd see it falling below that as well. But it's the case that we talked about before. It's one of those central banks who really have used up all their ammunition in the past. Interest rates are negative. What else can they do?
Mm-hmm, mm-hmm. So, yeah, this could be maintaining currency values. It could be a more visible headline that we see more. But I just also wanted to talk about economic data that's come out. Here in the U.S., the emerging numbers are coming out of the effects. We had Redbook this morning, which tracks same-store sales for general merchandise, up 8.5% in the week, year on year. That is a huge, strong total, and that is part of the the stocking up that people are doing. We also had the February retail sales report for as reported by the government for February. It was okay, but it wasn't as, it was mixed in there. No real, urgent signs of trouble, but some areas in February that were already showing weakness, we can expect to show weakness going on. That's autos, restaurants in particular, and one that's going to come up very strongly is non-store retailers, which are going to be benefiting from this. So there is an upending going on in the retail sector. It'll be interesting to see how it plays out, and unfortunately, I think will turn out to be a risk for March and first quarter consumer spending, and then going on into the second quarter.
Yeah, I'm sure that's right. I think when we're looking at numbers, as far as Europe's concerned, they tend to lag a little bit behind your economic calendar, so we don't have too much in terms of hard data on what's going on yet. But it's interesting that we've had ANSI, the French stats guys. They've already come out and now basically intimated that what they've seen just from their own surveys, they haven't published yet, sentiment in beginning of March for French businesses deteriorated at least as quickly as it did during the peak of the 2008 financial crisis. So it does look as if some of the numbers we're going to see coming out of France, perhaps not necessarily for February, but certainly as far as March goes, are going to look pretty horrible. And sticking with this numbers theme, it's worth mentioning just some of the figures coming out of a country where the virus has been around the longest, and that's China. So beginning of this week, we had retail sales and industrial production. These are combined figures for January and February because they don't separate them out at the beginning of the year. But retail sales there on a year-on-year basis were down 20.5%. And that's the first decline on record. Industrial production for the same period year on year was down 13.5%, and that's its first fall since early 1990. And one of their other measures they used, what they call urban fixed investment, for the first 2 months of the year, that was down 24.5%. So in other words, if you take those numbers at face value, it suggests that the Chinese economy was getting absolutely clobbered in the first quarter. And I think it's interesting, more and more folks now, I think, are starting to really revise down significantly their expectations for first quarter growth, probably second quarter growth as well.
And it shows us a hint of what we can expect perhaps in the U.S. and Europe. But the real story isn't the immediate effect or the initial effect, it's how fast the recovery begins. It'll be the next set of China data that will be the most interesting. That comparison is very easy for a March jump, which would maybe put everything in perspective. We also have to realize that the Chinese are setting an example for everyone else, both on how they apparently have contained the virus, and also perhaps how they can strike industry back up. Because right now, here in Europe and the U.S., we're, punch drunk from this. Right now, we're standing on our feet, dazed. So
no, you're right. Exactly the same in Europe. And I think it's interesting when you come down to these data, I think, I suppose in many ways, certainly for a lot of countries anyway, the upcoming economic data are going to look pretty blooming awful. But ultimately, I think it's still going to be the COVID-19 count that really drives market psychology. But at some point, these markets will start to look for some light at the end of a tunnel. And that's probably going to mean focusing upon whoever's furthest along the virus curve, which in this instance is China. So I think once we start to see new cases in China, and they've fallen clearly dramatically in recent days, if they can stay low and ideally decline further, then investors are going to start looking across thinking, well, hang about, the Chinese have done it now. Does this mean now Europe and the US start following down the same road? And then perhaps we get the opportunity for some really, really cheap equity purchases and everything else.
Well, and hopefully that would occur before too much financial damage is done to corporations and funds. Hopefully it'll be limited in time, but I guess, it's still playing out here in what is a very unknown thing. We also had job openings today, but this is data way back in January. They were up, but that's another thing. We're going to have, headline news, economic news shocks, when the layoffs start coming out, and they'll first be on a corporate basis perhaps, and then they'll be in the weekly data, the jobless claims data. And these might be some very severe numbers. They might be temporary, hopefully, but that's something else that is a risk, I think, to.
No, I think you're exactly right. I think one of the reasons why, going back to Sunday and all the, the Fed and the other central banks have to try and stabilize the markets. One reason why it didn't work was because people were completely taken aback by the Chinese numbers, which came out on Sunday evening. Okay, people assume they're going to be not very good, but the market consensus were absolutely nowhere close to these numbers. And as you say, the risk, I think, is that as this feeds through around the rest of the world, we will be seeing some pretty horrible numbers.
And Germany's, you had a sentiment number today that looked horrible.
Yeah, I'm always wary about these. Is from the ZEW guys who do. It's used by markets because it refers to March, so to that extent, it's very up to date. But by the same token, rather than actually looking at industry, it's a survey of what financial analysts are thinking. But that said, it really does. Well, again, it goes back to what I'm saying about China. Highlights just how this coronavirus has escalated much more viciously than people are anticipating. So in terms of the main headline numbers, the one that people tend to focus on most, I suppose, is the expectations component. Just in terms of numbers, it went from 8.7 to minus 49.5.
Yeah.
Well, what does that mean? Well, that was the steepest deterioration on a month-on-month basis that we've ever seen on record. So it just shows how much people are marking down their expectations.
And that's what these graphs are looking like, the ones out of China now. It's historic. The downside on this dip is a permanent historical feature of the economic data now. And will it just pop right back up, hopefully, like they often do, or will there be a time snag, or will it go lower? But right now, this is a pivotal moment here in the history of of modern industry.
It is, very much so. As you say, will it be V-shaped? Will it be U-shaped? Or indeed, will it be a very smooth U, which means we'll be stuck down at a low level for a long time? Difficult times indeed. Okay, right. Anything else from your side?
No, nothing.
No, right. I think so. Well, the way I summarise things up, you can tell how bad it's getting when the Irish pubs are going to be shut on St. Patrick's Day.
Well, that has to be unprecedented.
It really can't get much worse than that. Okay. Let's wrap it up there then. From Mark and myself, thanks very much for listening, as always. I suppose you've got to say that with these new sort of fiscal and monetary policy announcements seemingly as likely to be unscheduled as they are scheduled, there's even more reason for keeping track of the latest unfolding developments with Econoday's continually updated global economic calendar. Stay safe, and we'll be back next week. Bye for now.